Hey, this is Sasha. Welcome to another episode on Let's Talk Stocks. Today we're going to talk about the lazy way to be invested. So if you don't really want to do a lot, you want to kind of set it and forget it, that's what we're going to talk about today. So let's kind of get started here and go to number one. Now, number one is investing in an index. And if we look at the S&P index right here, you can see that, well, since many, many years ago, 1997, even since then, we went ahead and went up quite a lot. If you go into the S&P right here, you can see even from 1993 and 1992, the percentage of return, about 885 percentage of return. That's a long time. Now, that's quite a bit of time that's passed by as well, but it's a huge return on your investment. You can see just naturally, why does this happen? Well, it's because prices continue to inflate. A hamburger, many years ago was a lot less. Now it's more expensive. If you look at cars, they were a little bit cheaper back then. Now they're a little more expensive because they go ahead and put Bluetooth, they go ahead and put radio connections, and they just go ahead and raise the value and price. And it's just basically the value of money becomes less and less over time, so everything just gets more expensive over time. That's just the nature of price movement and fiat currencies. So anyways, you can't really buy the S&P directly, but what you could do is go ahead and buy the SPY, which is an ETF, and now you're basically invested in the market and you got about the same type of return because it follows and tracks kind of that same concept. So anyway, when you look at this, and you look at this return on investment, it's huge. And that's one of the first ways to really be invested in the market is through an index right here, an index that follows the market. Let's take a look at number two here. Number two, if we go ahead and do the lazy man's way of investing, that is to go ahead and get a target retirement fund or target date fund. And if you do a target date fund, what this does and the way that it works is at the beginning, you might be a little bit more risky. So let's say, at the beginning when you're just born, they might go ahead and put things in more speculative funds and stocks that may give you a higher percentage of return, but you whipsaw a lot. As you get older, let's say in your 30s and your 40s, it slowly reduces the risks. As you get to 50, it reduces the risk. So you pick a target date where you want to retire, kind of like, let's say, your birth year. And then you can go ahead and, hey, when do you want to go ahead and cash out this fund? So that's what they do is they go ahead and kind of adjust. Now, keep in mind there's some management fees sometimes and those kinds of things, but otherwise it's a nice, easy, lazy way to be invested. You kind of choose a timeline, what works for you in about, 15 years, let's say, target retirement, and then they'll go ahead and calculate, hey, here's some funds that may work. Here's kind of what you're looking for in returns. And boom, spits out some things. So that's another way to be invested in a lazy way. Let's take a look at number three. And number three is to just go ahead and get some gold. Kitco is a popular place to go ahead and get some gold. And if you go ahead and buy some gold, let's just say if you buy the gold bullion or you buy some gold coins, you could go ahead and do that. And as you look through these, let's check it out. I like buying Canadian maple things. Those are always fun. Here is, no pop-ups, please. 1 ounce of gold Canadian maple, you can see right now, is 1,352 each. So again, prices will shift, fluctuate, but you can go ahead and put them in the safe. The downside with this, of course, you got to figure out a way to store them. So if you got, 50 coins laying around your house, you lose them, kid swallows one goes down the toilet. If they're not in the safe, you get robbed, whatever. There's more risk attached to it in that way because they are physical, but it's a different way to invest. And gold prices do go up with time. And in general, if you look at let's just take a look at the GLD. Not that this is exactly equal to gold prices, but it gives you kind of an idea, and then if you got a pullback, it's kind of an idea for you. But look at the history of gold prices. They do continue to inflate with time. So you could do the same thing with silver. Let's take a look at the next one, and that is number four. And number four is a little bit more of a safer approach. Here's Treasury Direct. That is to invest in bonds. So number four, invest in bonds. Now, bonds don't necessarily have to be Treasury bonds, but this is one way to invest. So you can see right now you got a 10-year note yielding at around 4.35%. So you could go ahead and invest, 2 years, 3 years, 5 years, 7 years, 10 years. There's other T-bills, which are a little bit different. But there's also beyond just treasury bonds, you could do corporate bonds as well. They usually pay a little bit more, but they're less safe. So it's another approach to being a little more lazy, but still be invested. So anyway, treasurydirect.gov, government website, if you want to go ahead and research a little bit more and learn about how that works. And then let's go to number 5, which is our last one on the list, and that is just kind of mutual funds and other funds. So you could go ahead and just get a composite of mutual funds. I'm just using Vanguard. There's other mutual funds out there. Keep in mind, sometimes mutual funds lock you in. There's additional fees. But anyway, there's bond funds, there's treasury funds, investment grade bonds, or investment grade types of investments, so tax exempt ones. There's all kinds out there. You just got to do some research on what fits and works for you. Maybe you could even sprinkle some money in this one and that one and another one. So anyways, those are a few ideas for you. You could put a little money in gold. You could put a little money in ETF or an index fund, put a little money in bonds, mix and match, and then poof, you get more money later on. Anyways, thank you so much for joining me in this week's episode. Hope you found it helpful, insightful, and you learned a little bit. And if you're lazy, feel free to check out some of these investment strategies. And if you want to subscribe and make sure you don't miss any future videos, go ahead, hit the face icon, or of course, join me on my website at tradersfly.com. Thanks again for joining me, and I'll see you next time.